Hi, this is Francesco Nagari, Global IFRS Insurance Leader at Deloitte. Welcome to our IFRS Insurance Webcast. Today's webcast is focused on the outcomes of the IASB meeting on the 24th of October. The title of the webcast is The Board Prepares for Quick Fix Amendments to IFRS 17, but takes no decision on the effective date. The agenda for today is structured around three items. First, I'm going to give you the highlights of the meeting last week. Then we'll spend most of our time today looking through the detailed analysis of the discussion and the decisions reached at the board meeting. And then a few minutes at the end to talk about next steps. In terms of the highlights, the board had previously agreed that they would consider whether there was any additional action to be taken in order to address matters arising during the IFRS 17 implementation. This meeting was a first step in this assessment process. And it was different from the board meeting that was held in June when the IASB approved already a series of small amendments for IFRS 17, which will now be included in the up-and-coming publication of Annual Improvement Exposure Draft. This is the annual container that the IASB uses every year to make small changes to all of the IFRSs already issued. And there's going to be a significant number of small changes on IFRS 17 already approved. But what this meeting has done is actually produced some more serious consequences. And that has been marked by the fact that the IASB approved unanimously a set of criteria to amend IFRS 17. And these were contained in Agenda Paper 2C. And these will be criteria that will identify amendments which are sufficiently robust to be considered. But that doesn't mean that they're going to be necessary to be approved. And so there is a sufficiency test that comes from the criteria, after which there will be another assessment, which is the necessity or not to make those changes. The IASB also received feedback on the TRG activities, the meeting that I attended as a member of the TRG on the 26th and 27th of September. The staff highlighted that up to now, 81 submissions have been received, of which 32 have been dealt with in the plenary discussion of the TRG meetings. The next meeting for the TRG will be on the 4th of December, but that might be postponed depending on the volume and the nature of the submissions received or to be received. Finally, the IASB ran a Q&A session where they went through 25 issues which have been brought up in a single paper, Agenda Paper 2D, for their consideration. At this stage, there was no vote on any of these items. However, the paper, which I will encourage everyone to download from the IASB website, contains already the IASB staff preliminary thinking on each of these items. And the Q&A was designed to allow individual board members to ask questions ahead of the same 25 issues being presented again for an active discussion and vote in order for these concerns to be either turned into an amendment to IFRS 17 or not at all. And all these will be done under the public scrutiny. As you know, the IASB meetings are always public. You can watch them live through the webcam in the boardroom, or if not, you can replay later on the full meeting extent by picking the section that you are interested in observing again. Let's now move into the detailed discussion of this meeting, and starting from the IASB amendment criteria contained in Agenda Paper 2C. The IASB staff proposed 4 criteria to assess any amendment in order for that amendment not to result in significant loss of useful information or to be unduly disruptive of the implementation process already started. As we all know, IFRS 17 has been published in May 2017, so we are looking at a period already passed since publication of more than 18 months. And that means that we have a significant number of implementation projects being advanced in several markets around the world. These 4 criteria are structured in the way that I presented in this table. You can see it here. There is a group of 3 all connected with the overall objective of avoiding significant loss of useful information. And in order to establish whether there is or not significant loss of useful information, the IASB staff proposes to look at the possible reduction of relevance and faithful representation that a concern may trigger if the amendment was taken. The second one is to consider whether this amendment could reduce the comparability or create internal inconsistency within IFRS 17 and with other IFRSs. And finally, the third criterion within the significant loss of useful information is whether or not the resulting financial information produced after the amendment, proposed amendment, would increase the complexity of that piece of financial information for users. The fourth criteria is more operational in nature, and they want to consider an amendment to be sufficient if it does not cause undue disruption of current implementation processes, or if it does not cause a delay in the effective date of IFRS 17. So if an amendment has got all of these four features in place, it will be deemed to be sufficient to be analyzed for an approval if deemed to be necessary. If any of these concerns leads to an amendment that fails any one of these four criteria, the IASB staff has effectively indicated in their preliminary thinking that they would not recommend to the board to consider that amendment. So we'll see then later on which ones have gone in the buckets of possible amendments and the ones that are in the buckets of the unlikely amendments. Now, the staff noted that even if there is an agreement on any of these potential amendments, the necessity of passing the amendments remains fully in the hands and judgment of the IASB members, for which there are no criteria set. It's an entirely judgmental question informed by the general principles contained within the conceptual framework of the International Accounting Standard Board. As I mentioned already in the highlights, the board has voted unanimously for these criteria as developed by the staff. Before the board members voted, they expressed a palpable level of reluctance to make amendments, but they also acknowledged, and that's the good news, that there are issues in the implementation, and there is also a need for more time for implementation, expressed quite vigorously in a letter, in an open letter that the insurance associations of many jurisdictions around the world have sent to the IASB on the 17th of October, the week before the board meeting was held. And in that letter, the insurance associations, which claim to represent over 90% of the global insurance markets, requested that the IASB considers the amendment to the effective date by adding an extra 2 years to the current implementation timeline, moving the mandatory compliance with IFRS 17 from the 1st of January 2021 to the 1st of January 2023. In addition, the letter makes an explicit reference to another document also issued on the 17th of October by the European Insurance CFO Forum organization that contains 10 issues analyzed by that group of CFOs. And for each of those issues, the CFO Forum has produced also a proposed amendment to the text of IFRS 17 with a rationale as to why, in their opinion, the amendment is a valid idea for the IASB to consider. And the insurance associations, in their letter, they point to that document as a necessity from their perspective to make IFRS 17 a true high-quality accounting standards, which is ultimately what the associations of the insurance sector have said they would ultimately wish to achieve with this process. As they were considering all these factors, the board members observed that there are other stakeholders, investors, regulators, and they have actually given a very different perspective, and they want to see IFRS 17 to become effective as scheduled. So that is a complex landscape with stakeholders, important stakeholders, providing the IASB with a very different position regarding the need for IFRS 17 to be implemented within this time frame or a different one. In addition, and finally, reopening IFRS 17 would have an operational impact, which is why the IASB was clear in approving the fourth criterion in the set that the staff developed. Because they don't want to create a disadvantage. If there are insurance companies, in other words, which may benefit from a delay. There may also be insurance companies that may actually be disadvantaged by a delay because they started earlier, for example, or because they have already found solutions that can actually comply entirely with the IFRS 17 requirements. So all that will be taken into account. And the other factor to be analyzed here is the pairing, the coupling of the effective date of IFRS 17 with the deferral of the effective date of IFRS 9 financial instruments for those organizations that carry significant insurance operations. At the moment, the deferral and the effective of IFRS 9 and the effective date of IFRS 17 are locked down, and they are coupled at the same point in time, the 1st of January 2021. The consideration the IASB wishes to pay to that particular situation is that if they change the IFRS 17, what would they do to the IFRS 9 deferral? Would they change it as well or not? And if not, is the disruption that would be inevitable at that point during the period that follows the deferral end in 2021 and the beginning of IFRS 17 later, 1 or 2 years or whatever, whether that disruption is justified from a stakeholder perspective, whether the investors would need to be effectively suffering from the disruption that will inevitably follow from the decoupling of the two effective dates. Now, looking in more detail about the discussion that was held around this paper, I just picked a few points that I believe are of particular interest to all of you. The first one is that the IASB members generally commented on the fact that these criteria are very helpful, and they also set, it's an important point, a high hurdle for change. So they were happy that the hurdle is going to be high. Amendments might be necessary. They agree that, but they say only if it's clear that there are benefits for the change, and these benefits exceed the cost that insurance companies will have to incur to meet the objective of compliance with IFRS 17. And in doing that, they also want to continuously focus on the investors. And the benefits are measured primarily from the investor's perspective in terms of offering them greater comparability, consistency, and more transparency than they have today under IFRS 4. They also agree that any changes amendments should be narrow in scope and should be resolved efficiently and timely by the board. That's why in the title of today's webcast, I use the word quick fixes. This is the nature of those proposed amendments. We'll see later on in the webcast that the IASB staff already identified as likely to be valid under the 4 criteria. Board members were strongly in favor of the criterion A3 regarding the loss of information to users. If they feel that the amendment can create more complexity for an investor when they read the financial statements prepared under IFRS 17, they would normally expect to dislike that amendment, and so the chance of that amendment to go through will be slim. This means that the investor usefulness becomes a really critical factor as to what is going to happen from now on in the new phase of IFRS 17 standard setting. And finally, the impact of an amendment should be quite limited, generally speaking, given that this could be a cause for the delay of the effective date, and the IASB members, the vast majority of the IASB members who spoke at the board meeting last week would like to avoid the delay of the effective date if possible, and that already gives us a bit of a tone as to what is coming. It doesn't mean necessarily that when they're going to vote, they're going to stick to that, but reporting back to you objectively what I heard in the meeting, this is the feedback that you should take note of. The chairman concluded, and I thought it was also helpful to pick a couple of things that the chairman said after the votes. The first one, which was then picked up again in a speech they gave a day or two later in a conference. He believes that is absolutely critical for the IASB to complete the work on IFRS 17 to make it functional before the next financial crisis. Clearly, the volatility of financial markets and the influence that financial reporting may have in exacerbating the negative effect the financial crisis generally creates is something that Hans Øgervest has close to his heart, and he believes that IFRS 17 can actually be a mitigating factor to the severity of financial crisis going forward, by allowing investors to see probably the positive anti-cyclical contribution that insurance companies can play in the middle of a financial crisis. The second point is that risking the delay of IFRS 17 or disrupting its implementation is clearly very high in the mind of the chairman. And so changes to IFRS 17 must be focused on amendments which are just a fine-tuning of the current core principles and legitimized by an expectation that the resulting body of requirements will keep the cost as it is or lower. To me, that is quite an interesting context from a chairman perspective, given that he is the individual who could vote twice in any board meeting. As you remember, in 2016, when the IASB voted for the deferral of the IFRS 9 effective date for insurance organizations, the vote at the end of the debate was a tie vote, 7 against 7, and it was only the exercise of the casting vote right the chairman has in that situation that resulted in the deferral of IFRS 9 being approved. I'm not able to see that in my crystal ball, but I can certainly contemplate the possibility that when the vote on the effective date of IFRS 17 is going to be called by the chairman, that scenario may present itself again. And so the fact that the chairman has a casting vote means that we need to know better, if we want to anticipate the outcome, what the chairman is thinking about it. And that's why I've paid particular attention to his closing statement on this paper. Let's now move on to the other key paper, Agenda Paper 2D. As I said, it's a very important paper. I already encourage you to download it. It's a very long paper, one of the longest papers in the project, 61 pages, and that's because it lists out the 25 concerns that the IASB staff has collected from all the possible sources that have been interacting with them since the publication of IFRS 17. This includes the 10 points raised by the European Insurance CFO Forum. It also includes the 6 points that were raised by the European Financial Reporting Advisory Group in their letter on the 3rd of September, and many other sources, some of which are obviously of a private nature. We know, for example, that a number of national standard setters, like the Australian standard setter, the Hong Kong standard setters, and the Canadian standard setters, have been writing privately to the IASB this past month to also contribute to the preparation of this meeting. And so a number of the 25 concerns will also be coming from that particular source. What I intend to do in our webcast today is to explain what happened in the Q&A session. And to do that, I decided to divide the 25 issues in 3 parts. The first part, which is where I'm going to start from, is the one that contains the 7 items that will actually trigger an amendment, or likely amendment, I should say, of IFRS 17 based on the IASB staff preliminary thinking. 6 of these items will actually be a genuine change to what we have currently written down in IFRS 17. One will be just a clarification of what the IASB staff already explained to TLG members is the meaning of the words in the standard, but obviously TLG members indicated that they were coming from 2 different perspectives in terms of conclusions regarding that point. And so the proposal of the staff, and that is issue number 6, is to clarify the text to avoid that confusion. But it's a clarification rather than a genuine amendment of the requirements. So let's begin with the first 3. So the first one is actually issue 1. It's a scope amendment. There was no board discussion, so no questions were asked. That means that the content of the paper is quite clear. And the objective here is to introduce a new scope exemption paragraph from IFRS 17, moving certain transactions, mainly issued by banks, out of 17 and into IFRS 9. These are credit cards or loans, which also transfer significant insurance risk. And if there wasn't a scope exemption, banks will have to use IFRS 17 to account for them. The IASB staff believes that all the criteria are met in this particular instance, and the scope exemption should be justified. The next one is acquisition cash flows. Again, no board discussion. The paper was clear in setting out the staff thinking, and the summary is that they've considered this an amendment that could introduce some complexity for users, but they also believe that there should be not enough ground for the criteria to be failed, and so they actually argue in favor of that particular change. As I already mentioned, issue 6 is a clarification. Now, what it is that this clarification is going to deliver us is a clarification on how to deal with diversification benefits when we measure the risk adjustment. Back in the TRG discussion in May, we learned that the words in IFRS 17 are meant to set a single risk adjustment calculation and value at both subsidiary and consolidated financial statements level. That means that the diversification benefits are from the eyes of the issuing entity, the entity that issues the contract, which obviously is the subsidiary. And if the subsidiary takes into account certain factors, that's it. Those are all the factors that must be taken into account in measuring the risk adjustment. If the parent company, from a group consolidated perspective, takes into account other factors, those cannot be taken into account. And that means that potentially you have a different level of diversification that cannot be recognized in the consolidated financial statements. And that's the disagreement. Some TRG members express their view that this is not in line with the standard words, and the clarification, as we learned from the paper, is supposed to eliminate that ambiguity and make it very clear that there is only one risk adjustment. Some of the IASB members expressed their desire to understand better why this clarification could disrupt the implementation, as some of the TRG members already claimed, so that it's going to be clear when they come to a vote on this one, what consequences they're going to take by approving it. One perspective was that this is coming from a divided practice analysis of the current text, and so they also would like to understand what makes up the two camps in the industry and in the profession as well, in terms of those who favor or are against the single risk adjustment amount. The next one I want to talk about is issue 7 on the CSM coverage units. This is something that I've already spoken quite extensively in the past. As you know, during the TRG meeting in May, I took a significant amount of time to express my views on this matter, which are contrary to what the IASB has eventually approved in their June meeting, when they approved to make an amendment to IFRS 17 to introduce a new definition of coverage period for contracts that fall within the variable fee approach, and only for those ones. The modification of the definition makes reference to the fact that the service to be considered under the coverage is not just the insurance service, but also all the investment-related services that would normally be part of contracts falling within the VFA perimeter. I explained at the time that I did not agree with that approach because it created a bright line and ignored the reality, the substance of the fact that insurance are combined with investment-related services also in other contracts perfectly identifiable within IFRS 17, but that do not meet the definition of a variable fee approach contract. I'm pleased to see that the IASB staff preliminary thinking would indicate their willingness to consider an amendment to that decision in June, but the discussion indicated that some of the board members would actually like to understand more about why the June decision was not sufficient to address the concern, and more work on this particular point will have to be done before reaching a point of voting. We'll see whether the IASB staff is able, with the contribution from many other parties, including myself, to be ready for debating this topic in the November meeting, or whether this may require more time. It is clearly one of the most important ones, in my opinion, out of the 6 items that are already likely to be amended. The next one I want to talk about is the measurement of reinsurance held at initial recognition. This is issue 12. In this particular concern, the staff explained that there could be a possible amendment without losing any useful information, and also without causing disruption of implementation. but the Q&A raised the fact that the board wanted to have an analysis performed at a more granular level than it is contained at the moment in the agenda paper before they're going to reach a view on this proposal. After that, then there was the issue 15, which is the concerns arising from the requirement to present insurance contract assets and liabilities at the level of group of insurance contracts in the financial statements. This was raised previously at the time of the standard setting. One of the board members actually asked what the target outreach produced on this particular concern, and the staff confirmed that it is actually during the outreach that they became aware of the problem. Others were questioning why the field testing results were not giving that as a red flag in the past, and ultimately this will be debated for sure. But one board member said that the staff analysis appears to push the offsetting of assets and liabilities to a territory which is kind of uncharted when compared to the extent of offsetting that the IASB has accepted within other standards in the past. And so there was a word of caution that that board member may not be supportive of this amendment. And finally, they also observed that if this issue comes particularly from certain products or certain type of insurance business, the board would like to have more detail, because otherwise they will feel that there could be a potential fundamental inconsistency across other IFRS as far as the principle of no offsetting of assets and liabilities is concerned. The last one of the likely amendments is the openness of the IASB to welcome new practical solutions that can add further simplification to the modified retrospective approach. There is no conceptual resistance to change, so it's an invitation really to everyone who has got a brilliant idea to move that forward and to help the IASB to incorporate that in IFRS 17. Clearly, this is an example of where, if the criteria are all met, also the necessity will probably be passed on the grounds that if we reduce the implementation cost of insurance companies, there is a net benefit that should make this change a necessary one. Now, as I said, 25 items, 6 plus 1 will produce an amendment. What about the remaining 18? Now, there are 17 here where we had some preliminary staff thinking leading to a negative conclusion. And then one, which I'm going to deal with later, which is the effective date concern number 20, where the staff preliminary thinking was not disclosed, and quite prudently, of course, because it's such a sensitive matter. The IASB staff wanted to have that strategic discussion entirely unconstrained when the board takes it on in one of the future meetings. But in terms of the other 17, let's go through all of them. And again, I focus on what was the Q&A discussion at the board last week. The first one is Unknow Cohort. It's a very important one. So there was quite an extensive debate around it. Some members agreed with the staff preliminary thoughts on this, that it should not be amended because it clearly represents a fundamental reopening of IFRS 17, and that goes beyond the criteria that the IASB staff had approved just earlier. In particular, I observed that although there was some sympathy to the topic being an ongoing industry concern, the board wanted to see a much fuller analysis before considering the nature of any new information, given that this has been deliberated and approved extensively in the standard setting phase of the history of IFRS 17. Members also debated how to apply the criteria, the 4 criteria, and discussed the concern about the cost of implementation against the criterion of usefulness of information, given the evolution of profitability over time, would be materially impacted by a different level of aggregation. However, the cost argument is a piece of information that was already considered by the board in previous discussion, and so that should be taken in that context, i.e. there should be a discussion in terms of changes to the cost that had already been considered before, rather than redoing the same analysis. And finally, the board requested a further assessment of the second criteria against this topic, as this was not assessed yet. The second criteria is how does it compare this level of aggregation in terms of internal consistency with within IFRS 17 and with other standards. I must say that the level of aggregation is a unique feature of IFRS 17, so there isn't much to compare with other than internally to IFRS 17. So that is probably a reason, in my opinion, the IASB staff did not talk about that particular point. I would probably say that there is a degree of difficulty in itself. But what would be interesting is to actually consider the comparability of the level of aggregation within IFRS 17. That, to me, is a very useful exercise. In fact, you probably know that our public position as a firm in Deloitte expressed already since the comment letters to the exposure draft 2013 was published in October of that year, is that the unlocking of the CSM, in our opinion, would be better done at a portfolio level rather than at the annual cohort / group level. That, of course, is not what IFRS 17 says, but the portfolio remains a concept within IFRS 17. A number of assumptions are set at that level in practice. And in fact, there is even a paragraph 24, that says that when assumptions are set at the portfolio level, then the insurer must have an allocation basis to move that amount to be accounted for in each individual group of insurance contracts. So all that indicates that there is a merit, and I agree with the staff, so with the IASB members who requested it, to get further detail on how the second criteria would actually work in this particular concern. The locked-in discount rate had no discussion. This is the proposal to effectively unlock the accretion rate on the CSM, and effectively making the measurement of the time value of money for CSM an accounting policy choice, where some companies may choose to use the current discount rate at the balance sheet date, others may keep the locked-in rate. The staff believes that this creates inconsistency and also creates disruption of current implementation activity, so they say it will fail the criteria. Then the next one is measurement, a principle-based approach to discount rate and risk adjustment. Effectively, what the concern is that can we have more consistency imposed by effectively introducing a rule on the setting of the discount rate and the measurement of risk adjustment, eliminating that optionality. Some of the members during the Q&A actually agreed that this rule-based approach is not at all in line with the principles of the IASB standard setting activity, and so they rejected it and agree with the staff it should be rejected. One more member said that it would be helpful to analyze still this matter and amplify some of the thoughts about avoiding the use of rule-based approaches in IFRS standard setting, because that can actually help others to understand why the board has not taken that approach. The analysis could also be more specific as to what the consequences and implication would be if the IFRS was written in a different way, with a clear rule imposing one way to do a discount rate and one way to do risk adjustment. There were two concerns bundled together, issue 10 and 11, both connected with the business combinations accounting and IFRS 17, and both rejected as passing the criteria in the preliminary thinking of the IASB staff. The IASB inquired whether it's possible to have an assessment that is looking more at the usefulness of IFRS 13 information in order to complete the analysis of these two concerns, and also to look at the usefulness also from a loss of information against criterion A3, which is the added complexity for users by passing the amendment. This is clearly another marker for the analysis that will have to be displayed and discussed at a future board meeting. On issue 13, the insurance eligibility for a variable fee approach, there was quite a discussion. So the first point was that a member commented that reinsurance doesn't really capture the risk of the investments, and therefore the nature of the insurance contract should be assessed as to whether the contract relates to insurance risk or the investment risk, which is the predominant element. Another board member mentioned that it is a fundamental issue because IFRS 17 doesn't cover policyholder accounting, and there's been some deliberate standard setting activity in order to introduce the accounting treatment for the cedent, the policyholder effectively of our insurance contract. And so given that there is an absence of a framework for policyholder accounting, they will feel uncomfortable to take any views that would amend what has already been written in the standard. In particular, the matching concept could be an ideal basis theoretically, but it's not as easy to implement in the standard setting context of IFRS 17 as it would be if there was hedge accounting already in place. And so that was decided that it would not be to address this issue at the time of standard setting. So to bring it back, obviously that board member was inviting to take this into account. In assessing the criterion of loss of information, the board members also highlighted that it would be useful to understand what information may be lost to users regarding onerous contract, change of CSM, and separate presentation of reinsurance contracts. And finally, a number of board members just said that they would welcome the preliminary thoughts as articulated in the paper, which effectively confirmed that this item, 13, would fail the first criterion, the one on relevance and faithful representation, and therefore is not justified to move forward. Item 14 is another insurance held item. This is in terms of the inclusion within the contract boundary of cash flows from future contracts not yet issued. One view was provided that relevance is probably the most predominant factor to be considered, and if you read the analysis, actually that is not one that comes across normally. In what they've written, they would normally refer to the second in terms of internal consistency, and the third one in terms of additional complexity for users, but not the relevance. And so I suppose that this could be an indication of the staff to reassess their analysis of this issue, but not to change their conclusion. There was no discussion on presentation of premium receivables. Some people are suggesting that premium receivables should be brought back into the balance sheet. The staff preliminary thinking indicates that they are effectively no particular difference in terms of nature of cash flows to any other cash flows in the contract, and they feel that this creates an exception to the principle of IFRS 17 and therefore fails the point of consistency within IFRS 17 to make it an asset different in nature to the other ones. The OCI treatment as an option, issue 17, is a concern effectively about the options being in place in IFRS 17. Some investors in particular have been talking to their colleague, Nick Anderson, in the IASB board. He was a former investor, indicating that it would be much better if there was no option in that regard, and that everyone was either required to apply the OCI solution or not. The board already been through that, considered the feedback from users, considered the feedback from preparers, and decided that the option had to be introduced with a policy choice at portfolio level. And although there is a continuous appreciation of each party argument, the history as to why they got there is quite compelling, and so the other board members commenting back saying that they feel strong alignment to the preliminary thinking of the IASB staff that this removal of the option should not be passed. Also, there was no discussion about the other items on the page. Issue 18 is concerned whereby some constituents would like to have a broader set of criteria to include more contracts in the VFA accounting. Issue 19, there is a requirement in paragraph B137 whereby effectively every interim period that is reported in a set of interim financial statements as defined in IAS 34 effectively locks in that period from a assumption perspective, and you need to restart from the opening period that follows the interim period to set your assumptions, so that effectively the sum of the quarters or the sum of the half-year periods equals always the annual amount reported in the financial statements. Some people are saying that creates costs, obviously, because not all members of a group, for example, will be reporting interim financial statements at the same time, and that means that the parent company, for example, will have to be compliant with B137 in the group accounts, but the subsidiary would not necessarily, and that is a concern. But when they analyze these against the criteria, they find that this creates a reduction in relevance in favor representation, and also creates additional complexity for users. And so for these reasons, they rejected the amendment. The next one is a transition optionality. Again, an investor concern primarily. No questions here, but what it is effectively the IASB has heard that some people will actually have less optionality on transition, just one restatement approach for everything. In terms of the analysis against the criteria, this one is one that would actually reduce relevance and favor representation, because if it is possible to get closer to a full restatement, the IASB believes that it should be allowed and not overridden by effectively imposing everyone to do a fair value, for example, instead of having the choice between modified retrospective and fair value approach. Equally on the fair value approach, there is an element here about the resetting of the accumulated OCI under IFRS 9, but because of the relevance in favor representation criterion, the IASB staff thought that this should now move forward, and there were no questions raised during the debate. Now, coming to the last of the three parts in which I divided the items in the paper AD, paper 2A, sorry, 2D, I beg your pardon. These are the three issues regarding the effective date. Issue 20, which is the very effective date of IFRS 17. 21, whether or not there should be a requirement to restate comparative information, and issue 22, whether or not the effective date of IFRS 9 should be deferred further if there was a deferral of IFRS 17. I also draw your attention to the fact that the preliminary thinking of the IASB staff was negative for issue 21 and 22. So they said that those two items were not to be amended, and the reason is because they would add complexity for users in both cases. Now, this is an important discussion, of course, to understand where the board is moving from now on the matter that the industry has requested so vigorously and so vocally. One member, let me start with, one member commented that one of the constituents' view on removing the comparative period could reduce the implementation efforts within 1 year, whereas other feedback does not support this notion. But another board member noted that effectively this is equivalent to a 1 year delay. So in his opinion, issue 21 should be dropped completely and just merged together with the discussion on issue 20 as to whether, first of all, the IASB wishes to give a delay, and if there is delay, whether they should give 1 or 2 years delay. So that already starts setting out a bit of a scene in terms of what is the likely structure of the discussion to come. Finally, there was a comment on the need for comparative information, because this is something that obviously impacts investors, as indicated in the staff preliminary thinking. And so one board member suggested that perhaps some outreach to the investors could be useful at this stage to further investigate the requirement of restatement of comparatives. The discussion then continued on another idea from another board member who said maybe we should consider a two-tier model, whereby listed companies continue to work on a 2021 time frame, but then for unlisted companies we give them more time, given that there is a presumption in the mind of this board member that unlisted companies will have smaller resources and more difficulty to actually get compliant. But others suggest that if you introduce two different effective dates between parent and subsidiary in the same group, for example, you will create complexities that may be permanent. And the experience of IFRS 9, first-time adoption of IFRS, is a relevant precedent that should be considered in that regard. The other thing that I noted during the debate on this issue is that the effective date is problematic because some constituents would like IFRS 17 sooner rather than later, like investors, like regulators. You know that, for example, 3 of the main regulators in Europe European Banking Authority, the European Insurance Authority, and the European Securities and Capital Markets Authority have written a joint letter to their fellow regulator in the EU, the European Financial Reporting Advisory Group, the day after the industry letter was published on the 18th of October, calling up for an expeditious endorsement of IFRS 17 without amendments, saying that the European Union market would benefit from the clarity, comparability, and transparency that comes from IFRS 17, and they see no reason why that should be delayed. Investors in Europe, for example, wrote in September stating that they were puzzled by the concerns that the industry is raising around IFRS 17, and they feel that this is a good enough standard, and they actually want to see the benefits from it being applied in practice. So again, there are other stakeholders beyond the industry who have a different perspective, and this clearly creates a bit of a complicated scenario for the IASB members at the time when they're going to have to make a decision. They also appreciate that there may be different reasons for a delay, and so they've asked the IASB staff to do their best to try to keep track of the different reasons. Regarding the IFRS 9 deferral, then, the board considered that there's already been a long delay. So to me, those kind of comments would be indicative of a possible decoupling scenario. If the IASB eventually decides for a delay on the effective date of IFRS 17, I have got a strong feeling that we will have a decoupling situation, and the markets will have to face a period where IFRS 9 is implemented, but IFRS 4 continues to be the accounting standard for insurance. Now, it is possible at that point that those insurance companies who have not a need for a delay may actually early adopt IFRS 17. We shall see. It's going to be a very fascinating scenario if it becomes reality. With that, let me just take you to the last page, and then I'll open the Q&A. In terms of the next steps, the next ERG meeting may be held on the 4th of December. There was discussion as to the possibility of it being postponed, depending on the volume and the nature of the submissions received. And if it is, then the likely date is probably early next year, so there will be more time for submissions to be made. It is expected that November and potentially also December IASB meetings will stage extensive discussions on the concerns and implementation challenges that have been identified when the STAR paper was discussed last week, and that will allow each concern to be further analyzed in order to justify whether or not an amendment is going to be needed. I'm sure that at some point, but it's probably going to be one of the last discussion items, the issue of the effective date will also be debated and voted. So that is the end of the webcast for today, and I'd just land to my last page. And with that, I would like to invite the recording to be stopped and the Q&A session